Hello students, this is Brian from financialtrainingschool.com and welcome to GT215 Risk Reward Ratio. So this lesson will be different from the other ones in that I'm going to be teaching this lesson in the form of a story. So throughout the story I'm going to have mini lessons embedded into the story so that the story puts the lessons into context so that hopefully it's easier to grasp the concept. So here we go. Once upon a time there were two traders, a new trader and a pro trader. The new trader only recently started trading because he saw a pro trader consistently making profits in the markets. So for the purpose of this story, let's say he's an equity trader, meaning he trades stocks. So one day the new trader decided to ask the pro trader for help. The pro trader agreed to help, but only on one condition. The new trader had to follow his instructions exactly. If he said to wait, then he'd have to wait. Or if he said to sell, then he'd have to sell the stock. Also, the pro trader warned the new trader that before you even enter a trade, you must have a plan of execution, and this is lesson number 1. That is, you must not only plan your entry, but also your exit. I won't bother to explain the entry since that's basically what all the other series are for. So, planning your exit means setting your stop loss and take profit, e.g. your target price. Going into a trade without any prior planning is like walking into an exam without studying. You can't just wing it. Since this is money we're talking about here, not doing your prep work can result in a losing trade. So now you're probably asking, what are the benefits of having a plan of execution? Well, if you enter a trade at a specific price and you set your stop loss and take profit, technically speaking, you don't have to do anything else. You just have to sit back and wait for the trade to execute itself. As covered previously in the psychological lessons between GT206 to 208, you have to have the right mindset to trade effectively and you have to be emotionless to trade like a robot. And this is lesson number 2. A robot doesn't think, it just reacts based on its programming. In comparison to our story, the programming is the plan of execution. Once the plan is inputted, you just wait for the markets to move, then react accordingly. Whether the markets move positively or negatively, your trade will execute according to the input values. So now the pro trader gives a stock tip to the new trader. They both enter at the same price, let's say $100, and this is an earnings play, since it's earnings season, for example. The pro trader instructed the new trader to set a stop loss at $99, e.g. a $1 loss, and a take profit at $105, e.g. a $5 profit. And here's the backstory for the pro trader. So let's say the pro trader is more of a swing trader. So he's just aiming to grab some quick profits after earnings comes out and then move on to the next trade. So 3 days later, the earnings report came out positive, resulting in the stock to surge up on positive news since the actual earnings beat forecast earnings. The new trader, being inexperienced and greedy, wanted to change his take profit to a higher price. But luckily, the pro trader stepped in and reminded the new trader that he wasn't allowed to deviate from the original plan of execution. So 5 hours later, the take profit executed, and both traders exited the trade with $5 profit per share that they bought initially. The new trader wasn't very happy. With positive earnings report, he thought the stock would continue moving up. And this is usually what happens when you let emotions and or greed cloud your judgment. The pro trader reminded him that they were only in the trade for a quick flip on an earnings play. Recall, he's a swing trader. And this was covered previously in GT214. Time horizon is different between traders and investors. As a swing trader, we're not marrying the stock like investors do. Just because the stock has good news doesn't mean you switch from being a swing trader to an investor. If you wanted though, you could re-enter later on for another swing trade for a longer term period. Besides, they already had a gain of 500%. What more did he want? The new trader was confused because they didn't make a 500% profit. The stock didn't move up that much. It only went up 5%. This is true, but he forgot about the risk. So finally, we've arrived at our destination. Risk-reward ratio is the third and final lesson. And this is exactly why you need a plan of execution and trade like a robot. The pro trader went into the trade prepared to risk $1 to gain $5. But the new trader forgot about the risk. And this is a very common misconception for new traders. When they're opening a new trading position, in their minds, they're thinking they're going all in. But this isn't the case. Even with a stop loss of $1, they think they're going to risk everything for a measly $5 or 5% gain. But they're not. If it drops to $99, the trade will automatically execute a stop loss order and they'll be stopped out for $1. So in actuality, you're risking $1 loss for a $5 gain. This is actually a 5-to-1 risk-reward ratio. So you stand to make 500% on your money. After realizing this, the new trader started to realize why the pro trader was satisfied. Note, I didn't use the word happy with the trade. So that pretty much concludes the story. So when you're picking an appropriate risk-reward ratio, experiment with different ratios until you find the sweet spot for you. Different people have different risk levels and different people have different goals depending on how long they want to hold a trade for. So just set them appropriately depending on what you're trading. Typically, people use 1-to-1, which means they risk $1 to gain $1, so they're getting exactly what they're risking. Or they risk 2-to-1, meaning they risk $1 and they get $2, so that's doubling up. Anything above this is pretty much awesome. So in this story, I used a 5-to-1 ratio, which is a 500% gain. So $1 for $5, that's really great, and that's also really rare. The higher the ratio, the less likely it'll occur in the markets. So let's end off with a summary. So lesson 1 was a plan of execution. You do your research, figure out your entries and your exit points. Lesson 2 was trading like a robot. You follow your plan, you don't deviate from it, you don't let emotions or greed cloud or alter your judgment. Lesson 3, risk-reward ratio. Assuming you followed your plan, you should have a nice risk-reward ratio to look forward to if the trade ends in your favor. P.S. Hope you guys enjoyed the storyline of this lesson. I figured it would be the best way to put things into context. So that's it. Hope you guys enjoyed this video, and I will see you guys next time.